Hi, if you're new to my videos, welcome to my channel. This channel is all about investing for everyone in the world. And today we're going to work out whether we should buy Facebook shares and at what price. The strategy that I'm planning to use is that I look at the best investors that the world has ever seen and I take the best strategies that they have and implement it myself. Benjamin Graham, who is regarded as the father of value investing. His protege, Warren Buffett of Berkshire Hathaway, who is considered the most successful investor of all time. He has averaged over 20% and sits atop of a monstrous net wealth of $75 billion. Bill Ackman, the activist investor, billionaire, and CEO of Pershing Square Capital. And John Bogle, the founder of Vanguard Index Funds that now has $5.3 trillion under management. Some of that money is even mine. And the cool thing is we can adopt the same strategies that these guys have been using for decades and decades. So I think it's just a matter of following their unusual way to invest and we will eventually be rich. I say unusual because even though these guys are insanely wealthy and insanely successful, the majority of investors in the world don't follow their lead. Most investors think they can do better or they get sucked into the hype of a story around a company. So although it seems obvious to just follow what these billionaires have done for decades and decades, the majority of people just can't do it. But hey, that's okay. I don't mind playing it safe and I don't mind following their path. Now, the biggest criticism of the strategy that I'm about to show you is that the prices that I'm wanting to pay for these companies are generally really low and a lot lower than the market price. People say to me all the time that my prices are way too low and it'll never get that low. And my answer to that is, well, yeah, maybe you're right. But if it ever does get that low, I'm going to be really happy with the price that I paid. And sometimes just everything I look at is just too expensive. And for a lot of people who are new to the stock market, it's really frustrating because they really have this desire to get into the market. But the four legendary investors that I mentioned earlier, they would all say, be patient, value the company yourself, and wait for the price to get to your level. There are thousands of companies out there, so I just keep looking. And today we're going to dive into Facebook and see whether it's worth investing and at what price. All right, let's start the process with Facebook. And my first thing I have to do is I have to decide whether I think Facebook is going to be around for 20 years. This is always the hardest question. I really don't know. I'm not a psychic, and I'm going to have to take some sort of educated guess. And in my opinion, I think it is likely that Facebook will be around in 20 years' time. And these are my reasons. So when we're talking about Facebook, we're not just talking about the website. We're also talking about Instagram, WhatsApp, and Oculus VR because they're all owned by Facebook. Now, I think we might see the Facebook website actually start to decline over the next 20 years. But I think with WhatsApp and Instagram backing it up, I think they're going to grow a lot. Facebook are investing heavily into virtual reality with Oculus VR, and that's expected to grow at 100x over the next 10 years. We will also see later in this video that Facebook actually produces a lot of cash, and now that's really important because that gives them the opportunity to buy up any competitors or any other businesses that they think that could be some sort of threat. Now, I think Facebook's core business is actually data. And they have so much data through Instagram, WhatsApp, and Facebook. See, these platforms are how advertisers reach their potential customers, and the data that they have is just like gold because the advertisers can really specifically target their target customers. So as the advertising world changes over the next 20 years to be mostly online, I think Facebook are in the box seat to take advantage of this situation. So my opinion, I think yes, I think Facebook is going to be going strong in 20 years' time. Okay, finally, let's get into the numbers and see the actual performance. Firstly, the debt to equity ratio. And now this is just getting all the debt from the business and dividing it by the equity of the business. Equity just means how much money is left over for the owners of the business and the shareholders, which is going to be hopefully us. And this ratio pretty much means that if the company was to completely stop, would it have enough to pay off its debts? Now, this is important because a high debt to equity ratio means the company would struggle if anything was to change in their business, they would struggle to actually pay off their debts. This is important because a high debt to equity ratio means that the company might be in trouble if it doesn't have the ability to pay off its debts at some point in the future. A debt to equity ratio around 1 is okay, but I'm really looking for about 0.7. And Facebook's debt to equity ratio is 0.1. So they have hardly any debt. So this is perfect. Next up is the current ratio. And now this is an extension of the debt to equity ratio. And it simply just means that over the next 12 months, can Facebook meet its debt? But in this case, a number less than 1 is actually bad because it means the company will have to take out more debt to pay back its previous debt. My goal here is for a current ratio above 1.5. Anything above really 1.2, I'd probably accept. And Facebook's current ratio is 4.3, and that's one of the highest numbers that I've seen for a long time. So well done, Facebook. The book value per share ratio tells us if our investment in the company is growing. It has nothing to do with the share price. We are simply looking for reliable growth here to see that the company is actually just growing. And this is what Facebook's book value per share looks like over 10 years. So this is definitely a yes. As we have already covered the debt to equity ratio, now we want to see if it is trending downwards or stable at least for the last 10 years. If it was increasing dramatically, it means that the company is taking on more debt, and that's a red flag. So we're looking for hopefully a declining graph here. Now, I would give this a big yes for Facebook because we are looking for under 1, and they haven't even been close to that in the last 10 years. So it's a great sign they're making a lot of money. Earnings per share simply means how much profit is the company making for each share. This is very important because this is a really clear indicator if the company is actually growing or not. We also don't want crazy inconsistencies with the earnings per share. Stable is best, so we can predict the next 10 years. Here is Facebook's earnings per share over the past 10 years. Although 2009 was a little down, I looked into it a bit closer and it looks like it was due to a bigger than normal tax bill. Nothing to do with their revenue. I also think the growth speed is going to make it more difficult to predict the future, but overall it's going in the right direction, of course. Cash from operating activities. We need to see this growing because we can't invest in any company that their core business is in decline. Facebook has grown every year for 10 years in a row, so this looks great. Are they investing at least half the cash into investing activities? So for this, we check if the liabilities that the company has from investing activities is about half of the cash that they produce. This means that if the company is using the cash to invest in investing activities, they're actively growing their business. So they could be investing in other companies, buying more real estate, buying their own shares because the company also thinks it's a great investment. And it's a good sign to see that about half of their cash be put back into the business for growth. And Facebook has been doing this the past 2 years, so that's fine. Let's give it a tick. Return on equity. In my opinion, the most important number. This pretty much just tells us our return on our investment. A good number here shows that the business is performing well and management are investing the money into the business effectively. We are looking for a number above 6%. I actually really think it should be a lot higher than that. I'm hoping really for it to be above 15%. But if it's consistent and above 6%, that's good news. 1 year of bad ROE isn't the end of the world either. And Facebook's ROE is currently 18%, so this is very impressive. And even though there was a year below 6%, one below average year isn't that bad. So a big yes for such a high ROE. Dividends. Facebook currently doesn't pay a dividend, which is a little bit disappointing. I'd love to see a dividend, but I think the ROE number is more important. The ROE number is what we just looked at. Price to book value. Now we start checking to see if the share price is actually at fair value. We want this to be low, close to 1, because it means that the share price is valuing the company close to its current value. A low number also gives us what Warren Buffett would call a margin of safety. 1 is low, 4 is high. Facebook is 4.8. So unfortunately, this is a bit of a red flag. It means that the share price is possibly above fair price. Cash flow versus capital expenditure. We lastly need to compare the cash from operating activities against its capital expenditure. If capital expenditure is growing, things like more buildings, more machinery, more warehouses, but cash from operating activities isn't growing, then it means our ROE will start to go down in the future. We just need to see if the percentage of the capital expenditure to cash isn't trending upwards. With Facebook, the percentage is very stable, so that's a tick of approval. So by looking at all these ratios, we need to now decide whether we should continue on and value the company. The problem we face with Facebook is the price to book value. So the share price might be just too high. We will dive in and see what the correct price is in a moment. If we had any fails in any of the other criteria, we might not even bother looking at the share price. But Facebook ticks pretty much all the boxes, and we definitely want to invest at the right price. I'll leave a link in the description to the online calculator I'm about to use, and let's just dive into the calculator right now. So I'm here in the calculator that we're going to use. I'll have a link in the description. And the first thing we're going to do is estimate the average free cash flow. Now, if you click on the little button there, it gives you the inputs, the places you need to put the inputs. And what we're going to do is we're actually going to put the ticker FB down here and find the data. Now it pulls up the Morningstar data, which is a really good reliable source for data. So we're looking for the free cash flow. Here it is here. I'm just highlighting it all. I'm going to copy and then I'm going to paste it back into these sections. So here we go. Boom. And we're going to use this average free cash flow right now. Okay. So next thing we're going to do is we're going to try to find the annual growth percentage. So this is a little bit trickier. Again, we can type in FB and find the Morningstar data for this. Okay, great. And what we're looking for is the net income, which is the fifth line down, net income. There it is there. And what we're going to do is we're actually going to take just the last 5 years, because the first 5 years were very slow for Facebook. They were just sort of ramping everything up. So I've just grabbed the current number there for net income, and I'm going to grab 2015's number now as well. There it is.
Just copy and paste that across. Okay, so that was 2015 and 2019, and that'll give us an average growth rate for the net income, which is nearly 50%, and that's insanely high. But for this test, for this demonstration, we'll use that. Okay, let's move on. Yep, we're going to use 10 years as what we're going to think about as short term. That's fine. Just press continue. Okay, now the discount rate. Now this is what we want to make. So we want to make 15% ROI. So I just put in 15, press continue. Now after 10 years, what do we think the growth rate will be? It recommends having it at 3%. So we'll just keep it at that. I'm going to have to change that a little bit later, but that's okay. Okay, next thing is how many common shares are outstanding. Now I'm going to show you how to find this. So you go to Yahoo Finance. And when I finally get there, yep, I type in Facebook into the top search bar. And what I want to do is I want to go to statistics. And then I scroll down a little bit and you'll see the shares outstanding number there. Now that's in billions. Now, all the numbers we've used earlier were in the millions, so we need to turn this into a number that's in the billions. So 2,410 is better, is what we need to use. And it says, how much is your company trading for on the stock market right now on the stock exchange? And it's $182. So I can go ahead and press calculate. All right, now it tells us the intrinsic value is $700. So that is, at the moment, the price is $182, and we think it's worth $700. Now, there's some huge assumptions that we're going to have to go back and change before we decide this is the real number. 700 is insane if these numbers were actually correct. The big one we have to change is going to be the growth rate in particular. So what I'm doing now is I'm showing you how to find what we think the next 5 years of growth, the growth rate should be. So I go into Yahoo Finance, go to analysis, and there's growth estimates here, and there's a next 5-year growth estimate here of 14.33. We'll just call that 15% over the next 5 years. So instead of it being 50%, we're going to make it 15%, which seems a lot more feasible for a company to grow at 15% rather than 50, because 50 is just nuts. That's just not going to happen. So that's okay. Now the discount rate, we had it at 15. Now we're going to change it down to 12. Because I'm happy to get 12% ROI. And we just changed the 3 to a 5 in terms of what's going to happen after the 10 years. I've actually missed a little step here. I just pressed the calculate button a little bit too early. What I need to do is I need to go back up here and change the free cash flow that we arranged at the start. And I've actually got to take out the years 10 to 6 because we really just want the last 5 years because that's going to give us a more accurate number. So there it is there. Okay, everything else is correct for our updated calculation. Yep, okay, good. And we can press calculate. Okay, so this is getting a lot closer to what I think the intrinsic value actually is, and it's $188.51. That'll get us a 12% ROI on our money. Now that's pretty good. That's what I think that seems pretty accurate. Could change a couple of little things. Maybe this perpetuity change that to 3%. So that's how, after 10 years, what do we think it'll grow at? So it's got there $160 is a better calculation maybe of intrinsic value. So that's probably more conservative, and it's good to be conservative here. Let's just have a look at what it looks like at 15%. If we wanted to make 15% on our money, which would be really great, the intrinsic value is $110.66. Okay. So that's all we need to do for the calculations, and now we need to work out which one of those prices is the one we want to choose.
If you're enjoying this video, please like it for me just to help the YouTube algorithm. Now, after all of that analysis, we finally have worked out what we're willing to pay for Facebook shares. Now, firstly, I'm going to ignore the $700 valuation because that was assuming that it's going to continue at 50% growth rate over the next 10 years, which I think is just not possible. So we valued Facebook at about $188, and I think that is about fair value. And the cool thing is the share price right now is $181, so I'm going to go out and put an order in. But I would actually prefer to get a lot more shares at $160. We're a little bit more conservative with that valuation because we calculated that it's going to grow at 3% after 10 years into the future. Now, this is being conservative, but I think it's better to be pleasantly surprised than disappointed. So I'll put a big order in at about $160, but I'll also make sure I get some shares under $188. And it would be amazing if we could get Facebook shares at $110 like we calculated. That would be a seriously good deal. I'm doing this in late April 2020, so if you're from the future, say watching it later in the year or in the next few years, then please, you'll have to redo all the calculations. So that's it. I just showed you step by step how I decide what to pay for a stock. If you could tell me in the comments what company you'd like me to analyze next, the most popular company I will do a video on. And a big thank you for watching all the way to the end.